Good evening, everyone. Uh, Good evening, guys. Hope,
Good evening.
good evening, everyone. Hope I'm audible. Hope everyone's fine. Guys, please be interactive. I know that you all are there. Today there are two candidates. Today. Sorry for last Saturday. I think there was some miscommunication and we had to cancel the class. So you guys are available on Saturdays, right? Is there any problem with you guys? 3 to 5, everyone?
Yes, sir.
No? I was told that your classes are 3 to 5 on Saturdays. So and then changed to today evening. So we had some miscommunication. So our classes will be on Saturdays only, okay, 3 to 5, probably. So others who are not there, can get the recordings and try to be on available on that day. You can also be available if you're traveling. You can just listen to the call on your mobile also. So if you're not available doing it, attending from your PC. So the last class, I have told you to do the model. So let's recap. Let's recap. You guys tell me, okay, how to make a model. Okay, you guys tell me. Okay. Now here's a projection which I'm giving. Okay. Uh, and how I'm taking a year-on-year sales of 15%. I hope everyone has done the homework. I have told you to do the model. Am I right? Right, huh? I have told you to do the model. Or did I told you to, No, I told you to build this, do for FY 22. Okay. And okay, let's go on to the model. Okay, let's go on to the model directly. Let us see where have you done the mistake. Um, okay. Now 10% growth or 15% growth. How should I take 15% growth? What is it? 15% growth. How should I write it? Can anyone write in the chat box? Guys, please reply. Others also, please reply. How should I write this? Just write the formula. What should I do? 3059. Yeah, it has increased by 15%. Then I can do, yeah, 1 plus F7, right? Okay, this is what you do, and then you can just drag it. Okay, this was the first one. Okay, this is your first. Now since it was total, there was no other income, so you see over here the formula is over here. You can just copy and drag it. Okay, the total sales were 35,600. Okay, now I have told you over here COGS were directly, so I have done it for you. You can directly copy paste it. Okay, so this was what 69% of your sales. Now, if 69% of your sales, what will be a gross profit? Gross profit will be total revenue minus your total cost, COGS. And then what is your gross margin is this divided by. I hope everyone knows this. This is quite easy. They're going fast as of now. Okay, so our margins are 31. Gross margins are 31%. Okay. Now again, I have told employee growth of year on year means a growth of 6%. So again, if I say growth is this into 1 plus 6. Whenever I say growth, it is 1 plus the figure. And then whenever I say percentage of sales, it should be 11% of your sales. Okay, 3916. Fine. And total expenditure. Now, what is the total expenditure? You can write employee, which is like your COGS plus employee expense plus this. This is the total expenditure. Okay. And what is the EBITDA? Earnings before, that is your total revenue minus your expenditure. That comes to your total EBITDA margin. Year on year growth. Now I have to find out how much percent my revenue increase. Sorry, your EBITDA increase. It is this divided by -1. This 23%. This is my increase. Okay. Year on year growth. EBITDA margins. EBITDA divided by sales. Okay, I'm going a little fast because I hope everyone knows this. Yeah, total expenses, we have to take the all expenses. No, all the expenses. Total, na? It's total operating expenses. This is total operating expenses and this is your earnings before, I mean, after operating expenses. I bet that's earnings after operating expenses. In a depreciation. Now, where do we get depreciation from? Where do we get depreciation from? The fixed asset schedule. Now, let's go to the fixed asset schedule. Okay. Okay, now closing. The same way we have done it. Closing becomes opening. Okay. Then there's no sold. Sold was 0. So opening plus addition minus this. I had given you the capex. Now this over here and then just copy and over here. Okay. Now this closing becomes opening. Right? Depreciation for the year. What? This into this. And accumulated depreciation is this plus. What is the net fixed assets? Make sure you see, since all is linked, you can directly copy paste since all it has been linked. The net fixed asset is 10,8 minus this. Okay. Now you have got a depreciation, right? This is what you have got. 916 is your depreciation. Now you should link this to your P&L. See, now this we will take afterwards. Okay, all the schedules will take afterwards. Closing amount. We'll just do it for just now for our P&L. Okay. Right now we'll only do for P&L. So it will be equal to your fixed asset schedule. Like this. 868 for 22, and just drag it. 26. So I have done it till 25 only. You can just copy and just drag it. Okay. For 26, it will automatically. Then your EBIT. Now EBIT will be what? Your EBITDA minus your depreciation.
Sir, I had a small doubt, sir. In P&L itself.
Yeah, go ahead.
Yeah. So when we are calculating gross margin, like it was already inbuilt formula with the net sales with and the gross profit. But when we are calculating gross profit, you have taken the total amount and subtracting the COGS. So just wanted to check with you, like, do we have to is that okay, or do we have to consider net sales or total
You have to
services?
consider total sales only, because this is also part of operating income. No? Whatever
Right,
is
right.
part of operating, you should consider that. Now it is 0, so it's fine. But if there are operating income, you have to consider the operating income as well. What happens if you look at balance sheet?
Okay.
Will you find operating income?
So for gross.
Sorry. Net sales was what? Now previously, what used to happen? That sales, there was an excise duty previously. Now it is not there because of GST. Okay, so that net sales was revenue minus your excise duty. Now you see over here, there's other income. Now this is how a balance sheet is reported. Okay, this is all numbers. This is the format for a balance sheet or an annual report. In annual report, you get this format.
Right, right. Yeah.
From here, I have took this number. If you see, this number is coming from a link. That net
Right.
was what? Your revenue minus your excise duty. Now it is not there. From 21, it is not there.
Okay.
Okay. So whenever it is, it should be net sales, operating. So total sales, total revenue minus the operating cost. So total
And
revenue is other income over here, and I have written other operating income. Two different things. Okay.
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 Even the gross margin, even the gross margin will be percentage of
Total sales.
total.
Yeah, total sales. Everything should be on a percentage of total sales.
Okay.
Okay.
Thank
Now it
you.
is not there, but still, if some companies do, they have operating income. For this also, companies have operating income rather than selling, just bikes, Hero MotoCorp also sells different parts of vehicles, shock absorbers, sometimes engines and all. So those they usually also come into other income. Now they have not given, but sometimes they give. So that time you have to know that that also forms a part of sales. Okay.
Okay, sir. Thank you.
Now interest expense. We had done debt schedule. Okay, so I have just given you random assumptions. Closing becomes opening. Okay. Now it was what? Opening plus addition minus subtraction. Same way you can just drag this up and drag this down. It will automatically. Now closing was 45. Opening becomes 45. Then 45 plus 50 minus 35. You have to just drag it. All the black figures you have to just drag it. Now your total debt. What is the total debt over here? That is your 60 plus 335. This is your total debt. And interest. Interest will be what? Total debt into your 10%. That is your 40. Okay. All the numbers which you make sure you hold that. P&L, you get it, go to your debt schedule over here and then interest. Okay. Fine. Now earnings before interest tax, before tax is this. Other income I've told you to keep 0. And other income was 0. We didn't calculate other income. So your earnings before tax, again it will be this. Now other income will be added or subtracted. Other income is the income you receive from dividends, interest income, some gains for selling some land. It should be added. Okay, it should not be subtracted. And this is all exception item. You cannot predict this exception item, so it is all kept at 0. The tax. Now I have taken you that. I've told you that 25% is your tax. 25% into this. This is your tax rate. Okay. Okay. Now your profit after tax is 4115 minus 106. This is your profit after tax. And then you can just, I have done it year-on-year growth and your profit margin. The profit margin is to be taken on total sales. Fine. This is your assumption. Now, this was your first schedule that you solved. Now what happens once you get profit? Now how it is reflected in the balance sheet? Where it is reflected? Why only Manish is replying? What about others? Where is it reflected now? That is reflected where? In other equity and as well as in the cash flow. In the balance sheet, I asked where is it reflected in the balance sheet. Okay, it reflects in the other equity. We'll come on to cash flows later on. Okay, other equity. Now, other equity. Okay, this closing you already had. Now, don't try to do this. We will never tally. Okay, you are more interested in knowing the future of it. Okay, so this closing becomes opening. Okay. Then profit for the year. It comes from the P&L. Okay, profit for the year 3109. Dividends I had given you. Dividends I said that dividend per share is 100 and number of shares is 998 or 19.98. So how much should be the dividend? Should be 100 into 990. So it will be what? Opening plus profit minus dividends. This is your okay. This is your dividend. Now things I have done. Okay, now we have changed one schedule of the balance sheet. Now we'll go and change our balance sheet one by one. Okay, now we have changed this schedule. Let us see. Now we should change our other equity. This is already been tallied, right? FY22 is already been tallied. This is what I have just copy pasted from year to year. Okay, I have cloned the numbers from FY21 to 22, so I can get my balance sheet tallied easily. You know what happens? What I have changed? I have only changed this other equity. Right. What is the number this year? The number has been 16,847. See, you see a difference of 111, 111, sorry, 4 times 1. So what is it? Can I say in the other equity this year, profit was cash inflow or outflow? Profit was cash inflow, outflow. It was inflow. And dividend was what? Right in short term, in and out. Okay, outflow. Dividend was outflow. You see, the difference is exactly 111. Sorry, 4 times 1, 1,101, 111. See, right? You see the difference exactly. You see the difference. Now, how do we manage this? We'll go to the cash flows now. Okay. Now, what are the things we have from this schedule? Right? This was a cash inflow. Which activity is PAT? Which activity is PAT? CFO. You can see perfectly. It's there. No, CFO for 22. Now we are interested in 22. Okay, not 21. We don't care about 21. Okay, it is not related to our assumptions. It's 22 is what we. The profit after tax was equal to what we get. We can do all from the schedules only. Okay, profit after tax was this. So with this, should I say my CFO should change? My total CFO over here, cash generated from operating activities. Okay, I just do this sum. What I will do is to make things simple. I will do this all. So over here is equal to sum. Just do it everything. So whatever number I punch, it will automatically change my CFO. See, if I change any number, it changes my CFO, right? Okay, so what I do is sum, and so my total CFO as of now is what? 3109. Okay. Do I have anything in the investing activity as of now? I don't have anything. So just keep a sum and make it 0. Okay, I don't have anything as of now. Secondly, financing activity. I will do sum and then just add everything. Do I have anything in the financing activity from this schedule? Do I have anything? Do I have anything from this schedule, this financing activity? This we adjusted, right? What about this? Yeah, dividends paid. So it's a dividends cash outflow. Your cash outflow over here will be, now it is there, dividends paid is equal to minus, because it is a cash outflow. You go to balance, sorry, where was it? Other equity, and then there's an outflow. You see, now you see your cash flow activity has changed. So can I say that total CFO earned was 3109, total in cash flow from investing was 0, and total cash flow from financing was minus 1998. See the difference? Same difference? 111, sorry, 4 times 1. Same difference? Now this was the closing cash from last year. What will be this for this year? Closing becomes what? This is the cash was there in your wallet till last year. Okay, you start opening, closing becomes opening, and then okay, this is the cash that you earned this year plus you cash that you had last year. 1386. Where should it reflect now? Cash and cash equivalent at the end of the year. Where should it reflect? It should reflect in your balance sheet. Where was your cash and cash equivalent? Over here. Just go and change this to cash flow over here. Balance sheet tallied. No, we will not do it now. We'll do it later on. Okay, one by one. We'll solve one by one schedules. Okay. First, we have solved other equity. Now we'll go and solve fixed income. Okay. One by one, we'll solve and then we'll add and subtract all those things. So that now we don't, all the things are not to be done at once. If you do everything at once, you will never understand where you have gone wrong. You change one item, tally your balance sheet, then go and change the other item. That is the only time you will be able to tally your balance sheet every single time. You know, now also my colleagues, my ex-colleagues, now sometimes what happens, they say that Rishabh, I have done some problem. My balance sheet is not telling. Just see now where what mistakes I have done. So I don't see that what mistakes they have done. What I do is I remove all the assumptions and I start changing one by one. Sometimes you can make problems. You know, you can sometimes also do like adding. You might, for subtracting you might add. You know, for adding you might subtract. Can happen at times. For this cash flows, you forgot to put negative signs. Can happen. This happens. This is a human error. This can happen. But once you do one by one, you know, that time you will understand where have you gone wrong. You will get that, you know, see, rather than this, let us say I forgot to do this. Okay. You have done everything right, but you forgot to put this number. See what happens. Now you get a difference of 390. You will never understand where have you got this difference. Now, if you have solved everything at once and then check the balance sheet, you will never find, you know, what mistakes you have got. What you have to do is now again check where have you gone wrong. Rather than, I prefer doing it one by one. Okay. Now see how I do it for fixed income or fixed asset. Now fixed asset 22, we had changed. What was the number? 5183. I will go and change it in the balance sheet. No, it was how much? 5183. Fixed asset was 5183. Okay. Now see, I found a difference of 368. So till I don't tally this difference, I will not change any other item on the balance sheet. Okay. Now this 368 is what? See, I know that 368 was what? This 500 was inflow outflow. This is the only thing. Cash investing activity. So I'll just say outflow. And what is depreciation? Inflow outflow. What do we do depreciation on the cash flow statement? We add back, right? Because it's on cash. It wasn't a cash outflow as such. See the difference? 368. Same difference. Same difference. Now to tally this, there are only two entries to be passed now. What is it? Which activity is this? Investing. Cash flow you have already, it must be there. Capex is equal to, now don't forget to add this negative sign. Go to fixed asset, this. Okay. See, now you will find once you do this, it will get linked because I have, you know, summed this. So you will get an amount over here and this will change your total cash flows and at the end it will change your cash flows. Now you see the difference is exactly 868. What is that difference? You can clearly see it is a depreciation difference. What you do is the cash flow statement over here, you add back the depreciation. Right? 868 is the depreciation you add back. You see, now it automatically tallies. You don't have to do anything. Automatically it will get tallied. Let's go to our working capital. Okay, we'll come to that scale later on. Working capital. We have to find receivables. I hope you know this now. We have to find receivables. Can you find receivables for next year? Days I have given you. Days I have given you. Can you find? What is the formula for receivables? To find receivables. What is the formula for receivables? So finding days you multiply by 365. To finding receivables you have to divide by 365. That's it. And what is remaining now? Sales is related to what? Days of sales you have. No, what was the formula? Days of receivables into sales divided by 365. The sales do we have for 22? we can get the sales of 22 from your P&L. You know, we had forecasted sales, right? We are also forecasted COGS. We also forecasted COGS. And since purchases, what we say, we take it sales only directly. Okay, we take the same amount. Now receivables, days of receivables into sales divided by 365, 2731. What I have to do is just drag it. You know, this is here, so I have done it. You know, days of receivables, inventories goes with days of inventories, payables goes with days of payable. So what I do is I just copy and I just copy it, you know, drag it down. It automatically comes. I don't have to put the formula every time. I just have to remember one formula. Inventories, I know inventories goes with days of inventories, payables will go with days of payables. That's it. You got it. Now just copy. Just copy this. Paste it. You can do like this also. This is one thing. There is one more shortcut to it. You can select this. Select all from here 22 to 25. And we have done it till 26 now. We have done till 26. 26. What you can do is just copy, select till 26 and just press Ctrl R. Okay, Ctrl R. R for Russia. Okay. And this also assumption you can change it and automatically number comes. Okay. Now where is this reflected? Receivables have increased from 2275 to 2731. Inflow, outflow. Inflow, outflow. Outflow. Now what I will do is first I will go to balance sheet and change my receivables. One item at a point. I will first change my receivables. Receivables was how much? 2731. You see the difference? 457. You get the difference over here. Now, what is that receivables? Trade receivables over here. What should I do? I will go to all, do it from schedules only. Yeah, everything you do from schedule. What should I do? Previous year minus current year minus previous or previous minus current? Then outflow. So I want a negative sign. Previous minus the current year. Okay. 457. Got it? See now, same difference. Now it would have been, since I have linked everything, see, it would have changed. You see? My balance sheet tallies. Same way for inventories now. Go and link your inventories. Which number was this? This one. 221. See, at times what happens now when you do it, sometimes your linkage also gets, you know, sometimes you link the other year figure. So to do that, I always keep doing one by one. So I know that still I don't tally, I don't have to move ahead. 432. Same way. Inventories was what? Is equal to that again previous year minus the current year. See 432. Same difference. We tally. Same way for payables. Payables. Now, all other items on the balance sheet are not to be changed, nor it has to be, you know, you should not do any changes to other items because we don't know what is the impact. 12171. Okay. The cash flows, payables. All right. Payables now. Now should I do? Payables have increased. Inflow, outflow. Payables have increased. Your debt has increased. Means payable, your liability have increased. You had debt of 5264. Now you have debt of 65. So inflow, outflow. Rishabh. Outflow. How outflow? Your debt have increased. When you take debt, you get money or you give money. When you take a loan from bank, do they give you money or do they take money from you? all liabilities if increase, all liabilities consider it as your debt. Whatever it is, if you know that it is a liability, if the source of fund, then if your source of funds increase, then obviously your cash increase, right? So it should be current year minus your previous year. See 12171, the same difference in your balance sheet tally. See, all other items on the cash flows are not to be changed because this is coming from some adjustment that you don't know. We only know few adjustments. Okay, we only know few adjustments. Okay, now let me ask you, if I change this number, okay, investment, okay, my investment was 149, example, it became 2000. Okay, how should it impact my cash balance sheet? Oh, sorry, cash flow. My investments 1949 became 2000. What should I do? Cash outflow. Which activity now? Investing. By financing investment, now it is investment. So you go to cash flows over here. Now, if there is nothing you can add, now it is there, purchase of investments. Okay, what you can do is equal to, now you can link it directly with the balance sheet. Previous year minus the current year. You see 51, now there was a 51 increase, now your balance sheet will tally. Everything, whatever it's changed, you have to look it from the cash flow statement. Okay, whatever thing has changed. Now, okay, let us say for liabilities. Let us say your liabilities, let's say this other financial liability increased from 179 to, let us say 500. Example. How did it impact the cash flow? The other financial liabilities have increased from 179 to 500. What should I do? Cash inflow, outflow. The liabilities have increased. Now, which activity will it be? These are short-term liabilities. Okay, these are short-term liabilities. This is usually the loans taken for working capital. So this usually all short-term liabilities goes into. It doesn't go into financing actually. It goes into your operating. Usually short-term liabilities goes into your operations. You will see over here. You'll find something. You see other financial liabilities. All current assets, current liabilities usually go into operating. Okay. Okay. All current liabilities usually go into operations. So it is like outflow. So same way you can do this 500 minus this. And this you should know. See, automatically it will change this and it will tally your balance sheet. Okay. So all short-term liabilities usually go into, apart from borrowings, it goes into your operating activities. Okay. And this you don't have to focus it, rather usually do it because this is not a part of operations. We cannot focus. This is not actually related to sales. Now, when you go deep into it, that is the time you can change it. But as of now, you should only know, as a fresher, you should only know what is the impact. If something changes, what is the impact? That is the only thing that is expected to know as a fresher. Once you become more experienced into this, then you can find the assumptions of this. Why did it change, etc., etc. Now I have just changed it randomly. Okay. Now, ideally, you should keep everything same. Whatever you are focused, only those things are to be changed on the balance sheet. Okay. And if there's someone asks you any adjustment, what happens if this changes? So you know that what is the change. Okay. Now, if I ask you one thing, okay, 1949, okay, I say that this investment become 2500 and I have not purchased it. I will say that this is the gain that have happened. Investments are reported on the balance sheet at fair value, market value rather. There are two types of reporting. One is of book value reporting and market value reporting. Means this value. Book value means what? Your cost minus your depreciation. So book value is typically your cost. With your cost value. This is called a cost model. Okay, where everything is reported on the cost value minus depreciation. Okay. If it's an asset, it is depreciation. If it's an current assets, then it is just the cost. Market value is what? Your fair value. Means the fair value of the asset. Now, why is this two different? Does anyone know? Why some assets? Now car is reported on book value and your investments are reported at fair value. Why is it so? Anyone? Why do you report something at book value, at cost value, and something at market value? Why not everything on market value? Why not everything on cost value? Okay, but land is also, it is reported on cost only. Land also appreciates. Land is also an asset, right? It is also reported at cost. Why so? Anyone? There are two things. Why it is reported on book value? First off, because those assets are not taken for the intention of making profits. Do we purchase a car with the intention of selling it? When you purchase a car for your business, or you purchase a building for your business, is there an intention of selling it to make a profit? Why do we purchase assets? To run a business. When we purchase a shop, our motive is not to sell the shop, right? That is what we have to do the business in it. So whichever items usually purchased without having an intention to make profits are reported at cost value, because those are not made, those are not having an intention of making profits. Now what about investments? What is the motive for this? Do we take it to earn profit, or do we just take it and forget it? Why is investment held? Yeah, right now that is why we purchase stocks, right? We purchase shares because the intention of making profit. We don't have to run the company. When we say that I have purchased a stock of TCS, we don't mean that we want to run the company, right? Now we are here to make profits. So whatever things which have an intention of making profits are usually reported at fair value. Okay, because this should impact our profit and loss. See, now tomorrow, if let us say this was my land, okay, I assume this was my land. Land appreciates, right? Land appreciates. So if I say the land value from 5,500 became 6,000, example. So is it a profit for you? On the P&L, ideally it is a profit. But will you even ever realize that? Realize means will you even sell that land? Now your home, let us say you are staying in your flat. Now flat price appreciates. Do we say that I made a profit? Do we say that? No, because we don't have the intention of selling our own flat. Right? We don't have the intention. That is unrealized profit and loss. That when do we sell a flat? When we are in extreme financial distress. At that time we sell a flat. Usually, if a flat price increase, we cannot say that my profit increase. So those are not intention of making profits. Those are for you are staying into it. Okay. Same way for this, all the assets which have not have the intention of making profit are reported at cost value. Okay. And those assets which have intention of making profit are reported at fair value. This is the first important statement. Okay. First important reason. There's also one more reason for it. Now, ideally, what happens? Value of a car. Can you tell the value of the car which is running, in your locality? If a car goes, can you tell the price of the car? The current price of the car. You see a car, you go out, you see a car, you see a bike. Can you tell the price of that? You go and laptops, you have a laptop. Can you know the price, exact price of a laptop? The one who is using it. No. Ideally, it cannot be also checked. It doesn't have a live market. But if I tell you that, okay, find the price of a TCS stock. Will everyone have the same price? If I tell you, okay, guys, find me the price of a TCS stock, will everyone give me the same price? So this asset, the assets usually which have a live market are reported at fair value as well. The second part, second part. First part is always the intention. Second part is the one who has a live market, they can report the value at a fair market value, fair value. Now what happens usually when this property is there, let us say property, you can report it at a market value. Usually the property prices are known, usually. I'm not saying every time, but usually. Let us say you have two properties. Let us say you have two buildings. One is one property you have an intention of making profit. If I ask you two things, okay, you have two properties. For example, you have two properties. Okay. One you purchase for your own business, okay. Second, you purchase it for your, for selling it for investment purpose, okay, investment purpose. Now, if I say first year, FY22, okay, the price of the property that you purchased was, let us say both was 1 lakh, okay. This was 1 lakh, this was 1 lakh. Now next year, let us say the market value of this property is increased to 1,50,000. Okay. Now tell me, what should I report for this two? Should I report 1,50,000 for both? How should I report this? How should I report? Next year, the market value has become 1,50,000. When you purchase properties for own business, at what price do you report? When you purchase, do you have an intention of selling this? Do you have an intention of selling this? Now this property will be reported at 1 lakh only because you don't have an intention of making profits on this. Whether this property you will report at 1,50,000. Okay. Means cost minus depreciation if any. Now land doesn't have a depreciation, but let us say if this was something, property, plant, all this, then cost minus depreciation. All right. This is how the reporting happens. Cost value and the fair value. Okay. Got it? Difference between a book value and a market value. Book value reporting, it is cost. This is called a cost model. This is called cost model. This is also a part of CFA. Cost model. That is why CFA is important for financial modeling interviews. Even if you don't pass, the concept or the content in that is very useful to clearing your interviews. Cost model, and this is called a fair value model. Now listen the question carefully. I said my investment of 1949 became 2,500. I am saying my value increased. Okay. I am not saying that I have purchased more investments. Can happen. My stock value can increase. Let's say I have purchased one stock of TCS of 1949. Now it has become 2,500. Stock value can increase now. So should I report at 1949 or 2,500? What should I report at investments? Yeah, I should report at fair value. Oh yeah, I'm just removing this. So that I have not purchased, right? So can this entry come? Purchase of investment. Have you purchased? Have you purchased the investment? No, right? So this entry cannot come. I'm just deleting this from over here. Okay. What has happened? 1949 became 2,500. Now there's a difference of 551. Now here you need to adjust. Now what has happened? What has happened? You have done a profit. Profit is reflected where? Though you have not sold it, but it is a profit for you. You can say this is a profit for you because you have an intention of making, profits on this. That is why you have purchased this. So though it is an unrealized, so it is called unrealized profit. Okay. Now where will the profit reflect? Where will the profit? Yeah, it reflect in P&L. I had given you other income. So let us say this is a part of other income, right? It is not a part of operations. So what I will do is I take the profit. How much was the profit? It was 2,500 minus 149. This was the profit, right? Everything increased. Unrealized gain. See now whether my cash flow is telling. Sorry, your balance sheet is telling. Yeah, balance sheet is not. What would have changed now? No, unrealized doesn't go into OCI. Nishi, there are only 4 things that goes into OCI. Okay. Now, see what has happened if I change an item over, what all things change? When I say my PAT change, so my equity change, my equity PAT change, so my also cash flow changed. But did I earn a cash? Did I earn any cash? My cash flow also would have changed, right? Because my PAT changed. Did I earn any cash? See, ideally it should have been tallied, right? What has happened? See, 151 changed over here, and same thing, other equity also increased, right? Because of the profit. But did you actually receive the cash? Then what should I do? What should I do? Less unrealized gain. Less profit on sale of investment. Now they have, if it's not given, you can always add a row over here and do it. You can always add a row over. Always add a row over here and do it. Okay. Now since they have given profit on sale of investment, what should I do? Subtract, right? So I will put is equal to minus sign, and from the P&L I will just link it. This amount. See now what would have happened? Tallied balance sheet, right? See, what if I had done a loss then? What if I had done a loss? Acha, now cash. Okay, you said this. Okay, profit on sale of investments. Now this is not any activity. Okay, this is an adjustment. See, you see, this is all adjustment to your PAT. Okay, this is not any activity. These are all your adjustment to your PAT. Activity starts from over here. It's all your adjustment to the PAT. Now, but which activity was this? 1949 became 2005. Which activity was this? See guys, now this is a trick over here. This wasn't a cash activity. Not the cash has come in, nor it has gone out. This is not an activity. There's no activity. It is just the change in the accounting numbers. That's it. There is no activities that has been done. It is not an investment. See, investment is what we say that when we purchase or we gain something. Gain in cash. Did we gain anything in cash over here? Did we pay out? And so it is not a cash activity. This is again a non-cash activity, same as depreciation. Okay, where nothing has changed. It's just an entry which has been passed. Nothing has changed on the cash flow statement. Okay, if it was sold and then made a profit, then there was a different thing. Okay, if I would have said that I've sold this investment and made a profit, then it would have been a different thing. But now you have not sold anything. It's just the value has increased. Again, a non-cash item. And every non-cash item is not subtracted. This is a gain. That is why you have subtracted. Depreciation was an expense. That is why you added back. What if I tell you that 1949 became 1900? What should be the impact? 1949 became 1000. So you suffered a loss, right? You suffered a loss of 49. So what should I do in the cash flow statement? Add or subtract? different amount of footing is added under the adjustment. Yeah, you add the unrealized losses, right? So since I have put a negative sign, it automatically came in. Okay. So these are the things, which is written in a very difficult way in CFA books. I have personally, when I was doing CFA 10 years back, that time, I had mucked up all those things. Why I mucked up, like, add profits and losses. Sorry, subtract profits and gains from cash flow from operating and add our losses and expenses. This I had actually mucked up. I never knew what was the concept. Why you should add it, why you should subtract it. Just it was written in the book. That is why I used to muck up. Now these all things are not to be mucked up. This is all now financial modeling usually is relation with the CFA chapter financial statement analysis. Many of the concepts get clear in this. At least the first 4 chapters of that subject gets clear. Understanding P&L, balance sheet, and cash flows. You get all this to know in this model. Okay. Fine. Got the concept? How does it change? Huh? Everything is linked to your cash flow statement. Now let's change this borrowings. Now this was your long-term borrowings. Long-term borrowings was 45. That schedule now it was our long-term borrowings. 45 became 60. Okay, 45 became 60. So you have a difference of 15. In the cash flow statement, obviously the financing activity. Now over here, they have written it directly, proceeds and repayment from non-current borrowings. You can do like this. Can I say that 100 was inflow and 50 was outflow? Sorry, over here. It was non-current, na? Is equal to, let's say 50 was inflow, and 35 was outflow. Can I say this? 45 became 60, right? So inflow, outflow. Loan was 45, became 60. How much loan did you take? Can I say 15? 15, na? You can do this way also, this minus this directly, or you can do this way also. It's totally on you. Okay. So I know that this was an increase in interest. This is very easy. You see, it will automatically tally. The same thing, we change the borrowings over here. Short-term borrowings, we change it to 335. So now you can see a difference of 50. So obviously, you can again go to short-term borrowing, repayment. You can do directly also from over here. 335 previous year, current year minus previous year. You can do like this also. You can do 100 minus 50 like this also. All depends on you. 50. Then it tally. No, balance sheet is tally. See, everything tallied on its own. This is how you do it. Okay. This is how you tally the balance sheet. And those who have done it, see what was your mistake, where did you go wrong. Majorly is the cash flows where everyone goes wrong. Now, if your balance sheet for 1 year is tallying, other year will also tally. You have to just copy paste it. Now how? First you start with P&L we have forecasted, other equity we have forecasted, working capital we have forecasted, debt we have forecasted, and fixed asset also we have forecasted. Now what is this? Now just cash flows. Now start with cash flows. Copy all. I mean select all till over here. Track this side. Just press Ctrl R. You can also copy and paste it. It automatically take every linkages. All the linkages it will automatically take. Then, since cash flow is done, it's your time to just copy your balance sheet and just do it. See, the numbers have changed. You see, there's not same numbers. Numbers have changed, and you see the balance sheet is still tallying. Now all these numbers have changed. How much time did it take for me to make a model? 1 hour. That too I was explaining to you. Once I get all the numbers, it is just a half an hour job to tally the model. Now in interviews, you only get half an hour to tally the model. Okay. So if you are sure about how the changes happen, it becomes very easy for you to tally the model. So half an hour is usually a technical round and half an hour is usually a modeling round. Once you tell them that you know how to make models, they will give you different assumptions. Like assumptions I have given you over here, they will give you underneath. They will give you 4 or 5 lines. This is the assumption, this is the assumption, you take and you can do it on your own. And the one thing I missed, someone asked that, what about the interest? Even if you don't add interest, your balance sheet will still tally. Because interest is, it is a cash outflow only. How do we adjust interest? Your interest was 40. So it was a subtraction, right? Interest is an expense. Because of interest, your activity decreased, right? Your cash flow activity decreased. Is it the right way to say? Did your cash flow activity decrease? Cash flow from operation decrease? And now interest was 40. So it was subtracted from this amount. What should we do now? Interest means the finance cost. What should I do? How do we adjust interest expense? I told you. Others, how do we adjust interest expense? Now first we add it into cash flow from operations and then we subtract it from the finance, because here your PAT has reduced, means what? Your operating activity has reduced. But interest is not an active operating activity. It's an financing activity. So what you do is you add what? Interest, and this is one which they expect you to know, into 1 minus the tax rate. Tax rate is 0.25. This is when you add back, and then you make sure you see, now you will see a difference over here, 30. Make sure it is a cash outflow, okay? So make sure you subtract it back from your financing, and that is your interest rate. Is equal to, now subtraction is cash outflow. You can just link this amount only. Okay, 30. Automatically tally. Alright, tallies. Okay. Got it? I am not sending you this file. You try and do it. If you want, take a screenshot of the number. If you want, take a screenshot of your total assets. Obviously, this should tally. The number should tally. Take this screenshot. Those who have not done, do it again. Today, I am not sending you this file. You have to do it on your own. You have the video. You will get the video. Try solving it. Useful thing. This is actual model. Okay, this is how we also make the model. Okay. Interviewers, even in CRISIL, this is only what was asked to me for interviews. Not in CRISIL, 3 for MNCs. First, they tell you take for 3 years and then forecast for 5 years. Forecasting doesn't matter. They are interested in knowing how do you tally the model. If I change one thing over here, everything will change. This is what they want. If I do 30 over here, balance sheet number is what? 25,507. So change to 25%. So it should change. Change. And my balance sheet will still tally. Okay. This is what they expect you. When you get an interview, they tell you take it for last 3 years and forecast it for next 5 years. This is what they tell you. And it's very easy to do it. At least the modeling part. Conceptual is different thing. Sorry, the industry research is different thing. But at least the modeling, if you're going for a modeling job, this is what they expect you to know. Okay. So what we are saying, can you show the cash flow statement? Yeah, the cash was 2213 at 522. You first make this, and I will tell you how did I get this number now, how to copy paste from PDF to Excel. Okay. This is numbers I have given, but what if when you have to do it? I will tell you how the numbers, how all these numbers have arrived. Now all these numbers have arrived. This is I've given you. See, this is what I've punched. Okay, where do you get all these numbers? This you will not get in balance sheet. This you have to find in the schedules. First you make, and then we will come to this conclusion. How I will tell you how did I do this. Okay. Fine. Now 22 has already come. Okay, 22 year has already passed, so this numbers are already there. I will tell you how to copy paste this numbers and directly link to your. So this is a format that I have made. Okay, this is a format that I have made, and here this is what the company gives. See, it is all all jumbled up. I don't know how much growth was it. See, this was not a total income. This is coming from other income. So you see, other income I've taken at a separate space over here. You see, I've just linked. I just made this, my own. This is my own concept. I mean, I want this to look it more clean. See, here you can see ideally what is the percentage growth, what is the growth of my revenue, what are my gross margins, what is my percentage of sales. This is all I've got with just a click. Whereas over here, every time I cannot change. Okay, and this is the format I get it. So I have to just copy paste over here, and everything else will link it over here. Everything all get linked in my. I will show you how it happens. Okay, since I've linked everything, I have to just copy paste over here. It will automatically take numbers from this file. Okay. Now let's go to our working file that we did. Now, why have we doing all these things? See, this was the first part. Okay, tallying your balance sheet is the first entry to your interviews. That if you don't know how to tally your balance sheet, then they will start doubting your education only. First of all, if you don't tally your balance sheet, they will start They will start questioning your education. This guy doesn't know only what is account and what is finance. But even if you do make a model, if your balance sheet doesn't tally, what is the use of getting into a finance field? That's the first part. Second part, after doing this, now we should talk about that DCF. Why have we done all those things? What is the reason that we have done all these things? Okay. Why have we made this model? What is the reason? Now, why have we forecasted? To get some value out of it. Now, we are more interested in knowing in the cash that company has generated. Now, there's something called free cash flow to firm. Many of you have heard free cash flow to firm. It is called FCFF. Okay. Many of you must have heard. Now, what is this FCFF? Now, if I elaborate this more, FCFF is, listen carefully, FCFF is free cash available after paying all the operating and capital expenditure. But before paying to debt and equity holder. Okay. I'm saying it is the cash available after paying cash available after paying all the operating and capital expenditure. Okay, which are the operating expenditure? What are the operating expenditure? Means operating expenses. What are those? I'm just asking you. Talk about business. Which are the operating expenditure when you do a business? What are the expenses required for you? Interest is operating. Operating means which is related to sales, okay? The salary, inventories, okay, inventories, you wages, right? Related to day-to-day activities, fine. Okay. It's all expenses that you require. So if I give you a sales amount, can you find costs, even materials, right? Inventory materials, electricity, yes. This is quite normal, right? This is quite logic, not even logic. This is common sense. When you do a business, these are the expenses that you require. If I ask you to find the cash available, can you find? If I give you a sales of, let's say, 1 lakh and I give you expenses all, can you find the cash available with you? Yes, no? Yes. The same thing we did over here. You see, we started with PAT, assuming what this was our cash flow from operations, right? Then we kept on doing changes which is not a part of operations, right? Am I right? This is what we did. What we found, we assumed that PAT was our cash flow from operations. But then we understood that, okay, in that PAT, depreciation was also involved. So it's not a cash outflow. Right? It is not a cash outflow. Interest also wasn't a part of operations, so we added back. This all things which is not reflected on the P&L. Right? What it reflected? Additional inventory purchase, money not received, amount which is payable. Was this reflected on P&L? Other things reflected on P&L. That is why we use our balance sheet to get this amount from P&L. So can I say that your free cash available after paying all the operating expenses till here, all the operating expenses, can I say it is CFO? Can I say that it is my CFO? Right, not cash flow from operations, right? Am I right? Cash flow from operations, right? Now, cash available after paying all the operating expenses. This is what we have found, right? Operating expenses is included in the fact, and this is not a part of operations, so we excluded it, means added back, and then this is the part of expenses which is not reflected on the P&L. So this line item, free cash available after paying all the operating expenses. Operating expenses. Can I say the CFO? And what is my capital expenditure? That is my capex. Do we require to grow a business? Do we need to buy more land or more shops? Do we need to do or no? To expand your business. And that money should come from loan or should come from your operations. What do you feel? If you want to grow, good thing. What is a good? You can also take a loan and do it, but what is more, safe? To use it your own money. I mean, you should use your own money from operations or take a loan and grow. Okay. Taking a loan and growing also not a, it's not a bad thing, but which is more safe? Which company will you say that it is more safe? The one who uses his own money rather than taking loan. Loans are said to be a risky company. The one who has loan said to be a risky company. So in this example, what was the? Do we have the capital expenditure amount on the cash flow statement? Do we have? This is the amount. The capital expenditure means purchasing of a land or property, right? Which is that amount on this cash flow? That's a purchase of PP. See, though it is showing as investing activity, but can I say without this you cannot do your operations? Though it is a part of investing. Why? Because it has future benefit. But without this, can you do your operations? Can you? Right, you cannot do your operations. So that is why this is also the cash outflow that is to be taken into consideration. So what is the free cash available with the company is the cash that company earned minus the cash that company has spent for this capital expenditure. Well, that is your FCFF. This is your FCFF. Now there's no formula to it, okay? I have mugged up this formula. Even I have seen students who mug up this formula. There is no formula to it. It is a concept. Now, if you are doing a business, you will understand what is the free cash available to you. It's free cash before paying your debt and equity holders, and before paying off your interest and to equity holders. Now, it is just why there is a formula, because how is CFO derived? How was CFO derived? It started with PAT. Then what did you do? What adjustment did you do? You added what? Recollect now. What did you add? You started with PAT. You added depreciation. Then what you added next? Interest. So can I say interest rather than non-operating expenses? And just saying expense or interest. When the non-operating expenses. Okay. And anything else which was not in the PAT? Which were not in the P&L, sorry. Recollect anything else which was not there in the P&L but still you took in the cash flow? Yeah, change in working capital. Change in working capital. And there was one more thing you subtracted. Can I say non-operating expenses you add? Can I say you subtract non-operating gains? Just now we did it for Europe. Right now we subtracted gains over here. In this, we have just subtracted gains. Over here we told you something we subtracted, profit on sale of investments. Right, now this is it a formula? Is this a formula? If you know you start with PAT, this is only you have to remember it start with PAT. And everything else should flow on its own. Now this, whenever you add non-cash, if there's interest, the interest should be always 1 minus T. Okay, if there's a interest, because interest is tax deductible. Okay. What you do, you add non-operating expense, you subtract, and change in working capital. Change in working capital depends on how much have you invested. Usually you say it is less, but I will not write less over here. It is change means what? How much money you have invested in up and above your normal operating activity. Can I say your PAT? PAT was this. If depreciation was this, non-operating income was this, 1 minus T, right? And then working capital, I have done it over here. Working capital was this much. There was no non-operating gains in this example. Working capital gains was this much. I have also linked this. Profit on sale of less other gains. And capex. What was our capex? Capex was this amount. Purchase of. What is my FCFF now? I just have to add all. This is my FCFF. Now my FCFF is negative. Okay. Now let me change some numbers over here to get this, to get this positive. Okay. I got this a positive number. Okay, I've just reduced it. Okay. FCFF, free cash flow to firm. And here the firm means Yeah, it is possible. FCFF can be negative. Yes. And here the firm, now the word firm means cash available with debt and equity holders. Firm means debt and equity. Okay. Whenever you talk about firm, what does a firm over here means? Free cash flow to firm. Firm means debt and equity holders. Those are the two holders which contribute to the company. Okay. Whenever you say cash flow to the firm means debt plus equity. Okay. FCFF can be positive, so can be negative when you have a lot of capex to be done. Usually the capex plays a big part, and sometimes the CFO is also negative. When the CFO is negative, is it a good business? Your cash flow from operation is negative. Means that everything is running on loan. You're just taking loan to run your business, even short-term loan. Okay. The profit can be positive, but your cash flow from operations can be negative. Okay, this is free cash flow. Do we need to have a formula for this? Do we need to have a formula for this? If you Google it, you will find a formula for this. Let us do. Okay, let us Google it to show you the formula. Do you need this a formula or a concept? Was this a formula or a concept? One second, I'm sharing my screen. Guys, is it a formula or a concept? If I ask you tomorrow again, maybe next week, do we need to remember this? If you model this, if you know finance, or if you even use your common sense a bit, this is not a formula. This is, if you ask any businessman, whether he is from any other field, it is not that you should be from finance, you should be an MBA graduate to know this. You go and ask this to a businessman. Even if his 10 fail, he will answer you this question. What is FCFF? Now, just because the words are so, difficult, FCFF, free cash flow to firm, that are the things which complicates students. It is not that it's a complicated thing. Not even it is a rocket science. If you understand business, even normal giving and taking, I hope everyone knows this. Even a 10th standard guy will know this. When you were to sell, what is the cash that is remaining with you? That's it. All finance is depending on this only. How much you sold, how much you earn. Let me show you the formula for FCFF. Formula for FCFF. This was the formula. This is what we did. Net income is your profit. Depreciation. Interest. 1 minus T. Net working capital. Change in net working capital and the capex. We need to remember this. This is not a formula again. This is not a formula. The one who doesn't understand concept will mug up this. And in the interviews, they don't ask you the formulas. They usually ask you the concept. That is why the finance interviews are difficult. Because they will not always ask you this concept. Not ask you this formula. They don't want formulas because formulas everyone can mug up and do that. What do you mean by that? How do you arrive that formula? That is important. See over here you will never find this thing. Now what I've told you, non-operating gains, it is not there. Because interviewer, no, everyone just Google this and come to the interview and say this formula. Now what happens, like even when I used to take interviews, I have to ask, okay, what if there was another income? What should I do? You should add to net income or you should subtract it. Now, when this question is asked, you don't know anything because you have mucked up this formula. In that formula, it is not there. Because other income is not there for every company. This is given on a like to means that every company standard is this. Because every company will have interest, every company will have depreciation. This is the standard. Now, other income, it is not standard. Every company doesn't have it. This is the question. Normal question is asked. If you give him the formula, like people, students, candidates, someone who has great memories. If I tell you what is FCFF, they just give the formulas in one line. Net income plus depreciation, interest 1 minus T, minus capex, minus change in working capital. Now, if you give the formula so quickly, now be ready to, for you to, the interviewer will ask you a few questions. Now be ready to answer that. What happens when there's a gain? What happens when there's a loss? You don't know because you have learned this. You don't know the concept, how it has arrived. I have formula for FCFF. So that is formula everyone knows. See what formula is once you mug up, every Tom, Dick and Harry will know this. You go and ask your sibling and tell him, learn this formula, he will also mug up. What does it mean? That is important. When you go on job, you are not there to pass exam. You will not get marks in that. You have to clear interviews. You have to know the concept in that. The FCFF1 is fine. Formula is okay. It is not actually a formula. It's a concept. How is the FCFF arrived? Now I have, when I teach in MBA colleges, now MBA colleges typically there are engineers. They are like, sir, we are not from finance background. We don't know finance. We don't know accounts. In these 4 sessions we have had, I have not even used debit and credit words. Not even asset and liabilities I have used. Still I have told you how to make a model. Okay, so if you have that, that I am not from accounts field or I am not from finance, I am not an MBA, I don't know things. You are wrong in that then. If you give such kind of excuses, sir, because I'm not from finance field, I don't know this. Or just because I'm from finance field, I know so much formulas, I forgot all the formulas now. There is no formulas in finance, it is all concepts. You will only give me the answer for FCFE. FCFE. Now what is this? Now if I give you this words like this, you never understand what is it. Now what does that mean? 80% of the students don't understand only what does it mean. Now, what is FCFE? That is what? Free cash flow to equity. I'm not asking you the full form. This is what happens. No, it's not a full form. It is what? Free cash available to equity holders. Free cash available with, you can write 2 rather than you can write with equity holders. See, FCFF is what someone, if I ask in interviews, okay, tell me what is FCFF? Free cash flow to firm. It is not free cash flow to firm. It is the cash available with debt and equity holders. Free cash available, it is what? Free cash available to debt and equity holders. This is what I have, more elaborated it. If you know this, if you go and tell this to your interviewer, rather than selling FCFF is free cash flow to firm, he will not ask you questions after this, because here you have already given the formula in this. You see, was there a formula? He will just tell you, how do you commute CFO? He will not ask you what is the formula, because he will understand that you know the formulas. If you tell him it is free cash flow to firm, what is FCFF? Free cash flow to firm. Now then be ready to be green. The more fast answer you give, the more they grind you, because they know that you only have mugged up and come for the interviews. You don't know the concept. And being a fresher, no, they will, if you are going for a big company interviews, if you expect 6 to 10 lakhs of salaries, we expect to so that time you also prepare in that way. If you just go and learn the formulas, don't expect that you will get 6 to 8 lakhs, 6 to 10 lakhs rather. You get 2 3 lakhs. Be happy in that. Then this is how you upgrade yourself for interviews. You have the degrees, you have the qualification, but because of all these stupid answers, your salary decreases. What is FCFF? Free cash flow to firm. What is FCFE? Free cash flow to equity. Learn the concept and then go. See, he will only give you a hike you will not expect also. Salary expectation he will give you, very happily, rather than just now you will just telling just because you are MBA and you want salary, it will never happen. If you have the knowledge, tell him that you have the knowledge. Then automatically he will only negotiate on the salary. Okay. Now what is free cash flow to equity? That is the cash available with equity holders. Now I say that this is the cash available with debt and equity holders. Now I have to only find the cash which is available with equity holders. So means that I have paid off to the debt holders. Am I right? I have paid off to the debt holders. Now I say that 5 lakh is the cash available with you. Now you have to pay from this 5 lakh, you have to pay to debt holders. What all things do you pay to debt holders? What all things do you pay to debt holders? When you taken a loan, what all things you pay? The interest. So what should I do? Minus, add or subtract? This is 5 lakh available with you. Now you have to pay to the debt holders. How come add? We say subtract, right? You pay, right? You pay him. Pay interest. Okay. And what do you pay? What all things do you do to debt holders? When you have taken a loan, you pay interest and what else you pay? Principal, right? Again, less repayment. Right now? Less repayment. Achha. And can I say you also take loans from the debt holders? Also take loans from the banks, right? Right now? If you have debt, obviously you must have taken debt, right? So you add borrowing. If you want to take additional loans, you repay and you add, right? Add borrowing. So this two, if I club this is called net borrowings. This is just a word, okay? English word to net borrowings. Means what? How much you have purchased. Okay. Loan that you have. Now interest, do you have interest? An example, it was here only. See, interest, this was our interest, right? Now it should be subtracted. Interest you pay and repayment. Did we have repayment? No, that scale we have, right? How much we repaid over here for the debt schedule? Debt schedule. In first year, yeah, if the company is debt free, then FCFF is equal to FCFE. There's no debt. Right? We didn't repay anything, right? And then okay, we purchased. How much we purchased? We added this much, 20 million. No, that's it here. FCFF, FCFE. Okay, this is the formula, right? This is the formula, right? FCFE is a formula. First, means once you have got FCFF, you know now how to find FCFF. FCFE, again, there's no formula for FCFE. You have to just pay off the debt holders. What do you pay? You pay interest, you pay the principal, and you also take loans from them. That's it. So I think you are now sensible enough to know that repayment will be subtracted and borrowing is to be added. I expect that you should at least know this much. You have 5 lakh rupees, 5 lakh you pay, 1 lakh 40 you pay interest, and then you add more borrowing. This is the cash which is available with equity holders now. Got it? Now, if I ask you now, okay, let's recollect. Let us recollect your knowledge. If I want to find FCFE directly from PAT, how should I start? When I started from PAT, now how should I find? You tell me, okay. Let's say add depreciation, okay. Then what do you do? Add interest. First you add interest, right? Interest into 1 minus t, right? Okay. Now first let's find FCFF. Now we go to FCFF and then come to FCFE directly. Yeah, add non-operating expenses. That is, yeah, non-operating expenses. Then what do you do? Add depreciation. Then yeah, less other income, right? Less non-operating in gains. Okay. Then fix, yeah, less capex. Less capex, and this is also remaining what working capital. Okay, change in working capital. So this is said to be negative. Okay, it is said to be less change in working capital, but don't go with the word that less. Change means whatever you have invested. If the change is negative, means negative only you have to take. Okay, if I say the change is negative, majority of the time it is negative only. So don't again subtract it. Okay, a negative change means you have to take working capital as less only, because it is a cash outflow. Negative means you have invested in that company. Okay, positive means you have added. Okay, if I say that change in working capital is positive, means what? You are using your suppliers money to run your business. We'll come on to it when we come to zero. Okay, then CFF we got. Then what do you do? You got FCFF. FCFF we got. Then after FCFF, what do you do? First you pay interest, right? First you pay interest. But it is not a part of operations, no? And non-operating gains were included in your PAT. Non-operating gains you add, right, in the PAT. These are unrealized profits. Or even if you sell something, you earn a profit on that. That is not a part of operations. Yeah, and then add net borrowings. That's it. Net borrowing. Yeah. Rather than doing add net borrowing, we can say less repayment. Just go it whatever you understand. Less repayment, and then add borrowings. That's it. Those who know net borrowings can take, that is FCFE. And here, okay, now there's one more change. See, now here it was additional interest and subtraction of interest. So this will go out. And the same thing, add and subtract. What is remaining? These are the things which are remaining. Right? These are the things which are remaining. This interest, interest will go now. You add and subtract the same amount. Now you add and subtract. Right? For this amount. Okay. Now this is a formula, no? This is a formula, right? And Google will give you all the formulas that you want, which will, destroy your common sense. If you mug up formulas in finance, you will destroy your common sense. Free cash flow to, what is it? Free cash flow to equity. And they have started from EBIT. So EBIT, the net income they have just subtracted. Net income, taxes, add over depreciation, working capital, capex, net borrowing. So this is they have said this is income, okay? Total income. Fine. They have said that this is the fact. Right now, EBIT minus interest minus taxes is PAT only. Am I right? Then depreciation, working capital, capex, net borrowing. Right? Practice this, you will know. When you practice this, you will understand now what is exactly going on, how it is, how simple is it. You have just complicated things in your past. These things are very easy. There's no complications over here. Now let us find this, Clear everyone, any doubts before we proceed? Proceed more deep into FCFF, any doubts? This you have found from cash flows. Now let us find this from your P&L. Let me tell you how to find this from your P&L. Perfect. Let us find it for your hero. Can you help me find FCFF for hero? Can you find? Help me find. The FCFF is for next year, okay? Usually, because you are forecasting that. Can you help me find for hero? FCFF. Okay. How does it start? Starts with PAT. We'll do it for FY23. Okay. Now estimated. PAT. Then add depreciation. Okay. Then add interest. 1 minus T. Okay. Then what? Less working capital, less capex. Right? This is what we learned. Now where we get PAT, and we can do it all from cash flows, right? This we know that this is a cash flow from activity. Cash flow, what was it? This depreciation again in the cash flow statement. Okay, finance cost. Now it is already we had done it 1 minus T, right? So now what should I do with this profit on sale of investment? This amount over here. What should I do? What should I do this? What should I do? Add, right? You should. And you see it was there in this. So what we do is add or subtract. It was gain, now, but here we had told it is a loss. No, we had changed this number, right? Has come to a loss. So we'll keep this number same only. Where was it? Keep this number same, okay? Will not put. If there was a gain, you should subtract it, okay? There was a loss, that is why it was coming, okay, that way. And then working capital. So what is the working capital? We have three things over here. This inventories plus receivables plus payables. Here the number comes positive. What does it mean? What does it mean? I have invested 432 crores in inventories. Additional. I have invested 457 crores additional in trade receivable, but I have got a credit of 1271. Did I spend my cash over here? This was how much? This was around 888, and this is 1271. Now in this company, did I spend my cash? Now you tell me, what should I do? Should I add or subtract this number? 383. Change in working capital is positive. What should I do? Change in working capital. What should I do? Add or subtract? Let's see again what I'm saying. I have invested 432 crores in inventories. I've invested 457 crores in trade receivables, but I've got a credit of 1271. Means this money is of someone else. Am I right? I have to pay this trade payables. I have to pay. I have not paid it. So this money is there with me, which I have to pay. Example, this is the money that I have to pay to you. Okay. How much is 1271? And I invested this. So did I use my cash to run the business? As of today, I have to pay you 1271. Okay. But my expense is only 888. I have your cash with me. So as of today, did I spend any cash on you, on my business? Did I spend any cash? No, not yet, right? I have not spent any cash, right? Because I have this credit. 1271 money is your money, which is there with me. I have to pay you after 1 year. I have spent how much? I have only spent 888. So is it my cash? So 383 was a difference, right? So is it the cash available with me or I have invested? What does it mean? Is this 383 with me? Should I add this in my wallet or should I subtract it? This is available, right? This is available with me. So I cannot subtract this. Now this is exceptional things which happens when you go practical. Formulas all say that you have to subtract. Now change in working capital is to be subtracted. But change in working capital at times can also be positive. Means what? You have got a credit which is more than what you have invested. Now this doesn't happen with every company. It happens with few companies only. And you can see this in your working capital schedule. You see your cash conversion cycle. You sold inventories in 33 days. You got the cash back in 28 days. So you got the cash back in 61 days, but you are paying your supplier in 66 days. So are you using your own cash? Are you using your own cash? You are getting cash in 21 days, sorry, 61 days, but you are paying in 66 days. So this type of business has a positive, change in working capital. These companies never invest their own money. They invest their customers' money only. Now, obviously, every business, 90% of the business don't run on this concept. There are a few business which are very big, that is it. Anytime does it happen that let's say you are opening a shop, means you are taking your goods from your supplier. He is giving you 60-day credit and you are selling that good in 30 days. Will he give that much of credit to you? Means in this business, you are not using your own money only, right? You take it from supplier. Supplier asks you money after 60 days, but you know that you can sell that product in 30 days. Will the supplier ever give you that much of credit? Will he give? You tell. Of course not. How will he give him? And if he gives like this, then you are running business on, you are not using your cash only to run the business. You don't require only. Tomorrow you start your business directly. You take supplier, get a credit of 60 days, you sell that product in 30 days, and then after you still have product money with you. Yeah, then you are lucky. It will never happen. You can never be lucky in business. Everyone is a business people over here. Businessmen are very talented guys. The one who is selling you is also doing a business, right? They will never do that. So this can only happen when you are a big player. Like tomorrow, let's say you are running a small shop, okay? And tomorrow TCS comes and asks you, okay, I want 1 crore rupees of, milk products and chocolates and all from you. Will you ask TCS to give money on the spot? Will he even give you? He will give you. You know that TCS is a big company, he will give you. But obviously, he will not give you on spot. And those companies, big companies, only have this change in working capital, which is positive. The company who has change in working capital, which is positive, are said to be one of the best businesses. One of the best businesses in the world. Those have a change working capital is positive. This business are very safe business. Ups and downs in Apple, but this business will never go out of business. And this kind of companies will never go out of business. They will always have, and this you can say that this company will have a high market share. If I ask you, Maruti, what will be its working capital? Change positive or negative? For a company like Maruti. Positive? Why? Why positive? Goodwill. Okay. This can also be a reason, why it can be. No. See now, Maruti is a B2B business or a B2C business. B2B, B2B means business to. When business to business means two business people. And B2C means customers. Customers means us. Okay. So is Maruti B2B or B2C? Which business is Maruti? B2B? B2B means you sell your products to a corporate, another corporate. Whom does Maruti sell product? To customers or to corporates? Right? Maruti sells a dealer or customer only, no? Okay. A dealer will buy how many cars? 10, 15 cars. Maruti sells 1 lakh cars in a year. No, one dealer will buy how much? So it is B2C, okay? Customers. We sell, na? Ideally, who are the customers? We only, right? Dealer is okay, but dealers is also a retail guy, right? Dealer is not an institution. Now, not directly, but a dealer, right? A dealer is also a customer only, no? As such. Have you seen a dealer buying 1 lakh cars? You don't have such big kind of dealers. No? Dealers are small dealers across India. They are also customers only. So now a dealer will buy, 100 cars, 50, depending on his size. When Maruti will buy steel, now Maruti will buy steel from whom? Example, Tata Steel. Will he buy only steel for 2 cars, 3 cars, or 100 cars? How much steel will he buy? Tons of steel, tons of quantities. And when he sell his product, he sell it in units, buy in bulk and sell in units. You go to a dealer and ask him for a credit. You take a car and tell him, okay, I will give the money after 30 days. Will he give you the car? Will he give you the car? No one gives, no? You are not buying 100 cars that he will give you on credit. You go and buy one car, two cars, depend. So the one who is purchasing in bulk and selling in units, those companies usually are having this positive working capital, usually. And it should have, because they are buying in bulk and selling in units. Which other business you think is like this? Business to B2C business? Yeah, okay. B2B is what? Tata Steel, Maruti buying from Tata Steel. For Tata Steel, Maruti is a B2B. So for Tata Steel, Maruti is a customer, a corporate customer. So Maruti obviously will take a credit, right? Even Maruti will buy from Tata Steel, he will buy 1,000 tons of steel. Will he pay on the spot? 10,000 tons of steel. Will Maruti pay on the spot to Tata Steel? Will Maruti pay what 10,000? Obviously, he will get a credit from Tata Steel because he is not buying one ton. But where he is selling, Maruti is selling only 1-2 products, 1 or 2, or maybe 100 products to a dealer. 100 is also a big number. 50 products. So buying in tons and selling it in units. So for B2B is what Tata Steel selling to Maruti. It is B2B. And Maruti selling to us is, so Maruti is a customer business. Tata Steel is a business to business. Tata Steel is selling to a one businessman only. Maruti is selling to a customer. Okay. So buying in quantities. So for Tata Steel, so Tata Steel is which business now? Who is the end consumer of Tata Steel? Maruti and Tata Motors, or maybe other auto companies. So for Tata Steel is a B2B business, but Maruti, Mahindra, Tata Motors, these are all B2C businesses. Any other B2C business you know? Big B2C business? Any other? Ideally, many are B2B only. What about B2C? Telecom? FMCG, yeah, this is the main. Telecom do have a lot of capex, but FMCG, yeah, DMart, you don't get things on credit. Example for DMart must be buying in crores of quantities. And how much grocery do we buy? 1 lakh, 2 lakh, 10-15,000, right? We don't buy more than that. DMart must be purchasing in crores. And do DMart guy gives you credit? Go to DMart shop. Yeah, cement is also B2B. Cement is also B2B. Cement is using infrastructure, buildings, and all. Okay. And a DMart, let's say for HUL, Hindustan Unilever, go to a shop, Nestle even go to a shop and ask Maggie for credit. Will you give credit for your Maggie? All right. Now, oil is a debatable topic. Petroleum is not only oil. Oil is required for many other industries as well. It is not only for petrol. Oil is required for many other uses as well. Okay, got the difference? B2B, B2C. So all B2B business, B2C business usually have a working capital which is positive. So don't subtract that number. Yeah, manufacturers are mostly B2B, but this auto industry is, it depends now what kind of things you're manufacturing. If you're manufacturing cement, the cement is B2B. If you're manufacturing cars, it is B2C. If you're manufacturing something which is required in some industry, again it is B2B. Banks actually, this is, bank business is all cash business only. You take cash and you give cash. So yeah, it is B2C also, it is B2 institution also. Here the cash flow doesn't come in banks. Banks is all cash given, cash come. What loans is a cash, what you receive is also a cash. Here our capex was how much? Again, capex was in our schedule, it was, okay, sorry, we can take it again from our cash flow statement. It was how much? Our capex was 500. Here we can find our FCFF. So this is our FCFF 3389 is our FCFF. Okay. Fine. So now make a model. Make your model. The tally amount is 25. Did I change any amount? I changed the amount. No. Did I change anything? Okay, the tally amount is 25,543. Those who are interested, can make this model and we can, interact in the next what, where have you gone wrong, then I will send you this model. Okay. First you make this, okay, and then I will send you this file. Okay. So make this and send it to Soumitra, and then those who have had problems, see whether you are getting it or not. Just write this answer 25,543, so that you know that this is the tally amount. Don't just tally don't just tally forcefully. Okay, try to change numbers and see your assumptions and see whether the numbers are changing or not. Okay, and then once you get this amount, just drag it should tally. If it's not tallying, means you have again problem with the linkages. Loan, it is not loan exemption, Kushal. It is not loan exemption, it is interest. It is there in the working file. No, this file you already have. You have done it over here in your cash flow statement. See, first I have solved a dummy model for you, and then I've come to this one, and then I've come to a live model. Okay, so it becomes quite easy. If I directly would have started from this, you would have never understand what all things are there on the balance sheet. I hope now everyone understand now what are changes. If any change happens, what will be the impact on the balance sheet? Okay. Yeah, Manish. Right.
Am I audible?
Yeah, you are audible.
Good evening, sir. Sir, like we have forecasted 22, 23, 24, 25, and 26 of P&L account from 15% growth. Okay. If a company is projecting that this year will growth of 25%, then how we forecast the next year then?
Yeah, so just change numbers. No, this is what I've given an assumption. You can. That is why it is red. Now you can always change your assumptions.
No, I am asking that if 23 they are forecasting that 25% they will grow. Then in 24 how is forecast from 25%?
Now usually what happens? It is usually a CAGR which is taken. Okay, from here what will be the growth rate, and then it is taken. It is first it is looking at historical. If the company has given any guidance, then it is fine. Above that, is it 23? See, company usually give 1 year guidance only. After this, it is what you have to assume that what is the company will grow after this year. It is what it might be the industry growth rate. It might be a historical growth rate. It might be something that change that happened in the industry. So it is usually the industry or the historical growth rate. When you look at these numbers, 25 is okay. 21 only 1 year you will get. Next year it is historical or maybe industry growth. Okay. So ideally for a fresher, you don't have to take different numbers. It is usually taken same number only, because that is a different part into equity research. You have to know the company, you have to know the industry, you have to know where is the sales coming from. That is very deep. So as of now, you don't have to know that. But you just take a historical or maybe the industry growth. These two things are, better go with your assumptions. I know that auto industry grew at 10%. That is, I've taken 10%.
Sorry, sir, I'm interrupting you.
Okay.
Sir, actually, you told that 23 has given a guidance for 1 year. Okay. After that, we are forecasting through CAGR. Like if the country's GDP growth is 7%, like as for India. Okay. So we will forecast the 25 or 26 estimated from 7% or from CAGR.
No. So 7%. See, GDP is different. It doesn't mean that GDP is 7%. Doesn't mean that your company is also growing at 7%. GDP is for sales growth, it should be the industry growth. See, every industry doesn't grow at 7%. There might be some industry which is growing at a higher pace, some might be growing at a lower pace. So usually the industry growth which is taken, not the GDP growth, at least for the sales. There might be some industries who are growing at a higher pace, some might be going at a lower pace. That you have to find out, Google it, looking the annual report, read it in the MD and all, you will get an answer. Even if you Google it, you will get the answer. What is the industry growth rate for auto? Or you can take the historical rates. That is why you need to have 10 years of balance sheet of numbers with you, 10 years of historical numbers with you. Okay. Okay, guys. So we'll meet on Saturday. Till then, do your work and send it to Soumitra. Okay. We'll then, those who have doubts, we will clear it up. Okay. Try doing this and try also making the DCF at least one. I've got this number FCF is 3889. Okay. Then we'll start with valuation from next class. Okay. Okay, guys. See you. Have a good night. See you tomorrow. I'll see you on Saturday.